Let's drill down on the market reaction and where stocks can and will go from here. Joining us now to discuss this is Adam Phillips, the managing director at EP Wealth Advisors. Adam, thank you very much for being here with us. You just heard Sarat and my conversation with regard to the economic concerns facing the Fed. Why do you think markets largely have adopted this and are shaking off any growth scare that we may have out there?
Yeah, hi, Dom. Well, look, as Sarat said, this was clearly a dovish message. I don't know. I guess the only way you could make this more dovish is if Powell said that they were going to come out in September and cut by 50 basis points. They're not going to do that, but it's clearly they clearly have the evidence to proceed with a cut at their September meeting, and the market is taking that and running with it. I think the question is, are investors, as they tend to do, maybe taking this a step too far? And look at this as a series of rate cuts that are on the way. I noticed if you look at the Fed funds futures, pricing in up to 9 cuts between now and the end of next year.
All right, Adam, if that's the case, during my travels, I would talk to wealth advisors like yourself, and oftentimes we just have a conversation about why the Fed needs to cut interest rates, or when they can do it, or why we need this as a market. And I always respond a little tongue-in-cheek by, well, what do your clients say that are earning 4 to 5% on their savings yields and treasury investments? What's the balance for a wealth advisor right now between those two parts of the market?
Well, I think that's right. I think this is clearly an environment of the haves and have-nots. Those that have ample savings are certainly enjoying having getting a decent yield on that savings. Those that have a home are happy they've locked in. Those that are looking to purchase a home or first-time home buyers are, maybe it's a little bit of a different story. Those on the lower income tiers, we're seeing the fact that payments are slowing down. We're seeing a little bit of delinquency rates rising. So there are signs that there are some cracks in the consumer. On the whole, we welcome some cuts. We obviously don't want to overstay our welcome in the high-rate environment. It appears that, as I said, the evidence suggests that the rate hikes have been doing their job, and so it's time to start easing away from that. And I think that if done correctly, and if the Fed can navigate this environment and really solidify the soft landing, it bodes well for not just the broader economy, but also for future earnings growth.
Sarat, are you as constructive as Adam is with regard to the picture for the stock market right now? And if so, what exactly would you be buying? Is it just mega cap technology? It seems like it's just been the muscle memory for the past 10 years.
I mean, I think that's where the money's gone, but the consumer is definitely slowing. And if you get rates coming down, it's going to help them the most, right, in terms of payments, in terms of potentially, what costs of interest is going to happen to them. So I'm a little less sanguine. I think we've got a pretty fairly market, but you've got to look at opportunities where the market has not been. Doesn't mean you have to get rid of all your tech stocks. You still can own them. You just have to make sure that the sizing is right at this point. And I think you can find, whether it's in financials or basic materials or energy, utilities, there are valuation companies there that you can focus on that are below market multiples and also have better earnings growth.
All right, so Adam, let's turn back to you. What exactly goes on the shopping list? Where are you finding values out there? What types of stocks?
Yeah, well, absolutely, and it is outside of tech. We've really tried to avoid being bullied into owning the index weight of these high-flying names. Specifically within technology. And so I think you can find the opportunity outside. And I think that this earnings season that we're now wrapping up here is evidence that things are starting to broaden out. We expect that to continue. One area that we've added more recently is within discretionary. But obviously, this earnings season, I think, told us that those gaining share within discretionary are those that focus on discounts. And so specifically, I think about TJX. Which has come off a really solid quarter. They had a beat and a raise. We see this is a company that has a very strong balance sheet. It appeals to consumers in really every environment because they are an off-price retailer and really the biggest at that. But this is also a company with a strong balance sheet, $5 billion in free cash flow generation. And we've seen that this can go towards being acquisitive and doing so opportunistically. We saw that they just recently announced a 35% stake in Brands for Less, and it's a Dubai-based company. And prior to that, they announced a joint venture in South America. And so I think these are the areas that we want to focus on. Some of them have been left behind, but some of them are really just looking at other ways to play this market. And as we know that some of these other names have maybe been become a little stretched.